Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode of the show, I welcome a guest to share their news story of the week. And I'm delighted to welcome Paul Kitson, UK Head of Pensions Consulting at EY, to the show this week.
Hey Charlotte, really great to see you today.
Great to see you too. Do tell us, what is your news story of the week?
Yeah, thank you, Charlotte. So, I had very rich pickings, I think, for the week in terms of so much going on in pensions, but I chose this story here. DWP responds to WPC report on DB pensions market. We like our acronyms in pensions, don't we? Which was from the 1st of May in professional pensions. So that was what I selected.
And do tell us, why did you choose it as your news story of the week? What was it that leapt out at you from that piece?
Yeah, well, I sort of chose this one partly because of all of the stories I could have chosen. I thought this one actually covered a lot of what is happening in pensions right now. So we have reference to DB surpluses, we have reference to PPF, we have references to trusteeship, all of which we can unpack in a moment, I'm sure. But it felt like, maybe I was cheating, but it felt like a way of getting all of the stories into one.
Yes, well, we do encourage cheating on this show. So you listed quite a few things, and you're right, that article is very dense. But let's keep it to the top 3 favorite things stories that jumped out at you. What were they?
Yeah, within this, so the story starts off by talking about what the DWP will be considering potentially around changes to the way the PPF levy works. The PPF, the Pension Protection Fund, was established as a lifeboat scheme for defined benefit pension plans in the UK, where the corporate sponsor goes insolvent and there's not enough money in those funds to secure those benefits in full. The PPF was set up a number of years ago now, and of course, if we looked 5 years ago, even 3 years ago, then potentially it was staring down the barrel of potentially significant deficits coming across from DB pension schemes if businesses went insolvent. Roll forward to today, and partly driven by that big increase in interest rates that we saw a couple of years ago, through to now, it's in a very different position. So the PPF is sitting on a 10 billion plus surplus itself, and now has a very different view about the potential call on it going forward in the future. So the PPF levy, because the PPF is funded by a levy on industry, has kind of slowly fallen over time. And I quite like this, the maths geek that I am. The way the legislation works on the PPF levy is there's effectively something in there that says they can't increase their levy by more than 25% year on year. That was put in quite sensibly as a kind of, a break to stop the levy if there were lots of calls on the PPF going up very quickly. But what that means is if the PPF ever wanted to reduce its levy to zero, it's basically then stuck to never be able to call on a levy ever again, because 25% of zero, as we all know, is zero. So it's been in a slightly weird position where it's kind of wanted to say, we don't need to collect a levy. We have a big enough surplus ourselves now. Thank you very much. But we can't, because otherwise we'll be saying goodbye to the levy forever. So what has come up in this report is the proposal, which we might see in the pensions bill, to basically remove that restriction on the PPF being able to say no levy, but then be able to come back and ask for one later if they ever need it.
Ah, that's interesting. Yes, 25% of zero is still zero. And it's interesting about that because there's an alternative suggestion on the PPF levy, and I'm sure we're going to get into a greater discussion on this later. But with the kind of the revivification of pension schemes funding levels, as you said, when interest rates started to rise again, we are now seeing a debate as well of whether the PPF should actually be charging a small levy in order to basically uncouple pension schemes from their sponsor covenant and enable them to do run-on. And there's a feeling in the industry that will actually really open up the floodgates around run-on and allow many more schemes to go down that path. And that may well be of interest, not just to investment consultants like you, Paul, who would benefit from that, and asset managers, but maybe possibly also the UK government, who very much wants pension schemes to help them to invest in the UK. And whilst DB is a legacy scheme, future wealth growth is going to come from LGPS and DC auto enrolled, there is about 2 trillion stuffed away in DB, isn't there?
Yeah, that's right. Yeah, I mean, we have about sort of 1.5 trillion in the private sector, and then a bunch more in public sector and LGPS. It's fascinating, isn't it, Charlotte? I mean, I guess for those of us that kind of live and breathe pensions, we've been talking about kind of surpluses for a while now. I mean, obviously these sort of first really came to the fore when the infamous trust budget pushed gilt yields up significantly, which is the baseline effectively us actuaries use for calculating the liabilities. So that had the impact of substantially reducing the liabilities and therefore creating surpluses. But it's worth just thinking how profound a shift that was and has been. We came off the back of a decade from the early 2000s onwards of deficits, and seemingly no way out of those deficits. Pension funds working really hard to try and fill them, only to find that even falling interest rates even further created further deficits. So to suddenly flip to the position we're in now is profound. And you're right, the topic of conversation has very much shifted, and we might think of this as a luxurious problem, but the debate is now, as we find ourselves in the position we find ourselves in today, which is 3/4 of pension funds having a surplus on a self-sufficiency basis, 2/3 having a surplus on a buyout basis, potentially even more than that. What do we do now? Actually, is buyout the right thing after all? Now we're here, and for some schemes it will be, or this concept of run-on, and indeed seeking to generate further surplus to share with members and employers. So you're right, there's a big question around that. And of course, this has come at the same time where the government is now saying, well, actually, maybe this 4 trillion of pension assets we've got sitting in DB and DC can contribute to more economic growth. And have we missed a trick in not enabling pension funds better to invest in the UK and various different ways of doing that? So this whole question of run-on is really topical at the moment. And you're right, to get to your question, which I'll promise to try and answer. One of those ideas is, well, if actually we had the PPF providing full benefit cover, so even if the sponsor went insolvent, all benefits would be paid in full by the PPF, then would that not encourage run-on much more substantially? Because then trustees would be able to work on the basis that, well, even if things do go wrong, members' benefits are ultimately protected. Now, the knotty thing there is, do the maths work on that enhanced PPF levy? That was sort of, thought it could be at the kind of 60 basis points, 0.6% per annum of scheme assets. And I think that's felt that might be too big a drag on pension schemes to be willing and able to kind of pay. So that enhanced PPF levy question has perhaps gone away, but there are still, I think, a number of possible ideas and questions as to the way PPF could support the pensions ecosystem of the future.
You mentioned surplus there, and I know that was in your top 3 of things you like about this article. And I think it's definitely becoming a really interesting topic for debate. And in the way of sneaking more than one news story in, as you've started on that, I'm going to carry on down that. Another news story that you and I were talking about was one about companies cutting pensions contributions. And and given we all know in the industry that 8% is not going to be enough to give you an adequate retirement, the fact that some companies are sort of maybe using the cover of auto enrollment and cutting pension contributions surpluses could become even more important over the future, because there's also a debate on how those surpluses are going to be used, isn't there?
There is. There really is. And I've been quite open, I think, in talking about, as others have, the potential pensions crisis we have looming as the auto enrollment generation, the DC only generation, come to retirement and discover that they are significantly underpensioned. And let's not forget that in DC, over 90%, 9 in 10 members are sitting in the default fund. A good number of those won't even know where their pension is, haven't thought about pensions. They'll be thinking, I've been auto-enrolled into something, it's all going to be fine, isn't it? And sadly, it's not. So that crisis is looming, and it's not a million miles away now. So we don't have the luxury of kicking that can much further down the road. It starts to hit, I think, as early as the next sort of 5 years or so. So I'm quite a big believer, actually, in could DB surpluses be part of the answer to the DC underpensioning? And as I, in a very privileged position that I'm in, get to sort of tour the country, speaking to CFOs of large companies, small companies alike, it is very much on their radar, this sort of challenge we're going to have with pensions. And it's on their radar that, in fact, in the future, it won't be, even people not being able to retire at 65. It'll be well into their 70s. And that has financial consequences for those business. So I think there are CFOs out there, a number of them, that are open to this idea of using at least a portion of these DB surpluses, particularly where they've put a lot of funding in over the last decade, to support enhanced and higher contributions for DC members. That's good for the members, and that's ultimately good for them as a business too. So I think that is a really important ingredient, Charlotte, as you say, into this surplus debate, is how do we use it to help us solve some of the adequacy crisis we've got in DC?
I mean, I can certainly see the appeal of that, but if I were to put my government policy hat on, not that I just happen to have lying around here, the problem with that is that it solves the issue for some people, but not all people, doesn't it? If you are lucky enough to work at a company that has a DB pension scheme with a surplus, and if you're lucky enough to stay there for long enough that surplus can make a difference, it's still a piecemeal solution to the underlying issue, isn't it? That contribution levels are not high enough. And that is a policy issue that's going to have to be grasped at some stage, I can't help but feel.
You're spot on, Charlotte. And look, there is no silver bullet, unfortunately, or even a bronze bullet in pensions. And even if we can release significant amounts of DB surplus, and even if we can generate further DB surplus, unfortunately, that is not going to answer all of the questions. And we know, as you rightly say, it is a very disparate picture out there. We know that, for example, the self-employed gig workers have been left behind on pensions. There's more progress to be made there. We know, sadly, there's still a significant gender gap in pensions. Women, unfortunately, are much more likely to be underpensioned than men. There's a number of kind of drivers of that. So, the answer isn't going to be single-fold. And perhaps part of that debate also needs to be, what is the pension system for the future? So, is it DC with higher contributions, DC as we have it today, or in fact, does it look a little bit different? Obviously, could it be CDC? Maybe just to loop us back into the original article, that's one of the ideas that the PPF could do in the future, is could they seed and support CDC schemes, to discuss, or actually could it be, and whisper this quietly, but could it be a level of DB with then DC on top? And there's some work going kind of into that and looking at actually whether that could be the outcome. The current state pension, for example, is DB in nature. It would need to be DB that looks very different from the DB of today. I don't think anyone's suggesting restarting DB that has every individual employer with their own scheme. It wouldn't look like that. It would look very different. But could DB to an adequacy level to give everyone a fair income in retirement, and then DC on top, be part of the system? These, I think, are all going to have to be some of the tough debates and questions we're going to have over the coming months and years to think about how we move forward with pensions in the UK.
Well, you mentioned CDC there, and I'm not a fan. If you've ever read anything I've written about it, I've never been a fan of CDC. And I wonder if maybe Liz Truss kind of effectively killed off CDC by raising interest rates again, because CDC was a solution to sort of the freedom and choice issue, which was, what are we going to do for at retirement if people aren't compelled to buy an annuity? And now that annuity pricing has recovered, I know that decumulation and retirement income is a big issue for the industry, and it's something that people are grappling with right now. We've talked sort of about it at the fringes for a long time, but it is sort of moving up the agenda as we see the number of people who are going to start retiring with DC pension pots begin to grow. So is CDC a solution there, or is it just one part of that retirement income debate?
Yeah, it's another great question, and a really interesting debate for us as an industry, isn't it? I mean, I think it's worth saying upfront on CDC. Not that I'm trying to sort of talk you around at all, Charlotte, but there's CDC and there's CDC, right? And if you look at the Netherlands, they're moving from one CDC system that was very DB-like to another CD system that's quite DC-like. So there's lots of range in between. As you quite rightly identified, we've got whole of life CDC or decumulation only CDC. So there are lots of different models here, and I think different things to debate. To your question, there's a lot of thinking going around what is the decumulation product of the future. The world at the moment is pretty much drawdown, where it's sort of completely up to you, what you want to do and how much you want to take, kind of you pays your money, you take your choice, or annuity, guaranteed, but very inflexible. It's going to die with you, other than maybe a spouse's pension. So there's, that's it. And that does gloss over some really good work some of the providers are already doing in launching new products and, target date funds that go beyond retirement. There is work going on, but I think we need to have and providers are working on, I think, an even more expansive look at what good decumulation could look like. I think CDC decumulation only could well be part of that. You can see that sort of structure, as long as it can be successfully explained to individuals, being something that maybe some people want. So I'm not saying it will be part of the sort of landscape in the future, but I think there's certainly those that are thinking about could it be. But I think there is also wider work going on as to, well, actually, are there different ways of using different balance sheets, different capital providers, because there's a lot of capital looking to invest in UK pension to maybe develop more annuity-like solutions, but with a bit more flexibility, a bit of an ability to change your mind and say, actually, I did think I wanted an annuity, something's happened, I need to take some money out of it and reduce my income. Are there kind of structures like that can kind of work? So I think we're going to have quite a expansive debate around that over the coming years. We also need to think about care costs. We know a sad side effect of getting so good over the last decade of getting people living longer and longer and into their 80s and 90s is now the much higher prevalence of dementia and the sorts of things that result in very significant late life costs. How do we manage those? Are those insurable risks? Where do they sit in this sort of decumulation story? So we're going to have to deal with things like that. With all of these solutions, the bottom line is we're going to need to get better engagement. I think, we can't keep, to use the phrase again, kicking the can down the road of saying, well, it's okay that people aren't engaged in pensions. I think we've got to try and continue to get people into their money in a different way, particularly the younger generation, in order to be able to fit the right solutions to what people may need.
I'm going to push back on that, because I'm not sure that I think that we kind of proved with all the work that we did with the Pensions Commission, which was an astonishing amount of time ago. I think it was like 25 years ago now, in that we proved that engagement and getting people to think about long-term doesn't work. Is not the solution that we all have. By we, I mean the providers, some form of at-retirement solution that people are defaulted into, because we also know from annuities that people were encouraged to shop around for annuities and they didn't do that. And if we can at least have some minimum standards and regulations around the at-retirement solutions that are offered by different people, that's probably going to be the best situation for the mass pension market. Agree or disagree on that?
Yeah, it is a very, very fair challenge, and me, Charlotte, I'm an optimist, glass half full kind of guy. So maybe I am optimistic, but I suppose I just and undeniably we will need structures like that. We will need defaults. We will need to accept that there will be many who won't, for very good reason, engage in their kind of retirement income, and it's not going to happen quickly. I'm not even talking 2-3 years, longer term than that. But I suppose I fundamentally believe, I think one of the things that I'm really keen on in the DC space is around thinking about what the money is doing during the investment stage. And I think we really lost sight of retirement saving and pension saving as being, I'm giving my money to someone, off it goes, I've got no interest in it, like forget about it until retirement. Whereas in fact, that money is doing a lot. It's investing in a lot of places. It's investing in companies. It's helping develop, many wonderful things in the world. And I think we need to get, and I suppose I'm a bit of a believer that maybe technology is going to be part of the reason to doing this. We need to get that link back to investing and getting people cognizant of what their money is doing. So, and I think that's how we possibly start to energize and help some of that engagement question as people are thinking about, well, yeah, I can't touch that money because it's retirement income, but I still do have a real vested interest in how that money is invested and what it's doing. And, you know, and I think technology will enable us to be much better than that. I mean, I can see a day when, you know, your Amazon bar at the top has a filter that kind of says list by company that my pension money invests in. You know, I think we're moving to a world where that sort of linkage, that sort of provenance of where your pension money is invested is going to become much easier so that people can engage in it more. I guess the other thing, which I suppose, you know, time will tell whether I'm too optimistic on but having finally got there on dashboards, I say got there, about to get there, obviously, so a little bit of a way to go, but now we're successfully linking in. We are about to wake up many millions of people to their pensions savings and their pensions assets. When I look at what I think will come down the line in terms of, which obviously Torsten Bell, the pensions minister's talked about recently, on minimum default consolidation. So if you have a pension pot that's less than 1,000, it's not going in anymore, automatically moving that to a vehicle. I think all of these things are going to be ways that we can nudge people to sort of understand a bit more about where their pension is and what their pension's doing, such that we can lift that engagement bar. But your challenge is right. You know, we've got a long way to go on that, and you know, maybe we don't have enough time.
Okay, so if we're after that long, interesting debate about the future of workplace DC and at retirement solutions, let's return to sort of the legacy issue of buyout and surplus. And I know this is something you and I have talked about a lot, but how is that debate evolving? It seems to kind of move quite swiftly, which is quite phenomenal given the slow pace of the pensions industry. Where are we with that debate? How are things evolving? Are more CFOs, you run around the country talking to them, you said, are more CFOs open to the idea of run on? Is DB trauma fading?
Yeah, I've been surprised by the level of engagement by CFOs in the run on discussion and debate. And by that, I mean, you know, willingness to consider run on, because to your question, you know, the legacy pain of DB, you know, that I've had the last decade of actuaries turning up every 3 years telling me I've got to put more money in as the CFO, you know, that's going to resonate. But I think for a number of reasons, CFOs are open to the question. One is, I think, you know, they do understand that the surpluses of today are built on a very different foundation to the surpluses of yesterday. So one of the challenges, I guess, the pain of DB of the past was, you know, for years in the 90s, you told me we were in surplus and we had all these holidays. Then we swung to a decade of deficit. So we're going to have a few years of surplus and another decade of deficit. You know, the surpluses of the 90s, early 2000s were built on, you know, kind of an expectation of 8, 10, maybe even 12% equity returns that were baked into the numbers. The surpluses of today are built on an investment strategy that expects a return that's lower than the insurance company is going to operate if you do a buyout. You know, the average pension scheme investment strategy today is lower risk than an insurance investment strategy on buyout. So it's just a very different place that we're at. I think, you know, CFOs also acknowledge that actually a lot of the capital that's going to back a buyout deal, if a buyout deal is within the premium. So there is a question of, well, should they retain that capital and run the scheme themselves? Now, many, and it may well be many, and may rightly be many, will still conclude, you know what, off balance sheet is the right thing, buyout is the right thing, that's where I'm at. And, you know, I've got several clients in that, very much in that camp. But I think there are a number that are much more open-minded to run on, given what I just said, and as I alluded to earlier, the potential to use some of that surplus today and it's generated in the future to solve, you know, what they might view as pain coming down the road in DC if they don't take some action now.
Okay, so I'm going to grant you a wish from my genie bottle, because you picked an article with lots and lots of things stuffed into the article because there is so much going on in the pensions world. If I were to wave my magic wand and turn you into pensions minister for the day, what would be the 3 things that you would want to change about pensions?
Oh, that's a great wish. That's a great wish. Well, and I mean, so before I give you my answer, I mean, we have a very active pensions minister today and doing a lot of wonderful things. I mean, it's possible that the pensions bill, which could come as early as this month, might have within it, changes around super funds, around value for money, around targeted support, around surplus consolidation, small pot consolidation, CDC, PPF levy, and Virgin Media. So we may already have a pensions minister that's found quite a magic wand and is seeming willing to tackle a great number of subjects. So let's see. I mean, I think my top 3 as a subset of that would be, I think clarity on surplus would be really helpful. I think we're going to get that. I think that's something that's quite big, I think, for the industry, both in terms of surplus release today and in the future. I'm quite a big fan of targeted supports and what that will unlock. I think for too long as an industry, the limit on providers to be able to help guide individuals as to what might be in their interest has been too fettered by a fear that they're going to stray into regulated advice. And that was a well-intentioned regulation, making them nervous around that. But the consequence of that is where they could give good advice to many people have not been able to. So I think what targeted support has done is accepted that there might be a small number that maybe do make the wrong decision, but actually the masses get to a much better result. And I think that's healthy and good. So I'm hoping that will be there. If I was Torsten, that would be my magic wand. And then finally, value for money for me is really critical within DC. For too long, again, very well intentioned, but we've had a big focus on how do we minimize costs of DC plans? How do we reduce that to an absolute minimum? And, as I say, that was well intentioned, but that's actually resulted in a really bad unintended consequence, which we've invested people into very low returning, very low risk asset classes that are lower cost, but not necessarily delivering. So I think let's make some progress on value for money, get people invested in net of fee, higher retirement outcome investing products. And I think that will go some way, not all of the way, but putting us in a better place for pensions for the future.
Well, if I were to turn my magic wand on myself, I would definitely pick you up on the value for money, because I do think that's really important. I do think we need to learn the lessons that Australia have made, the mistakes they've made probably around that policy, and make sure that we don't sort of end up with a sort of quarterly performance overemphasis and make it something that's long-term. My other one would be for people to grasp the contribution lever and do something about that. And I know that's obviously very tricky in the current economic growth environment, but you never know. The government could do something useful on that too. And I don't know, there's this big continent next to us that maybe we could get closer to. That might help growth. Obviously, don't expect you to comment on that, Paul, but that would be my tuppence. I think that's probably a great place for us to leave the podcast. So I just want to say thank you for being on the show, Paul. It's been great to have you on. Thank you for all your insights and giving us so much to think about in a mere 30 minutes. Listeners, I hope you enjoyed the show. And if you want to make sure you never miss a future episode, then do hit the subscribe button and engage with us wherever you can on whichever platform you are consuming the podcast. Thanks for listening.